Awesome. So we got some more people signing in. I really appreciate everybody joining. I'm really looking forward to doing this today. This is the first crypto CPA Q&A that I'm doing, and hopefully we're going to do these somewhat frequently, either on a quarterly or monthly basis, depending on how it goes and how the overall feedback that I get here today after this event. But there's a lot that I want to go over. I've had people on LinkedIn, via my newsletter, as well as Twitter, submitting questions for about the past like 2 to 3 weeks. And there's a lot of ground to cover. I don't even think we'll get to all the questions today, but I want to get to as many as possible. So I have a good list here of questions about topics ranging from regulatory topics related to some of the crypto regulations that we're seeing, year-end considerations for investors, Web3 businesses, tax implications to certain types of transactions. So I want to go over all of these topics today. And then to anyone that's listening, you can go ahead and leave a comment on this event post and ask questions that way if you want to ask them during the event. And also, you could, I think, raise your hand within this event as well, and I could allow you to speak, and you can ask a question in a live format as well. So I really want to make it easy for you to get your questions answered any way possible, basically. So I think we got a good group of people in here. Thanks again for joining. So let's get right into it with some of these user submitted questions, and then I'm also watching, and I'll repost here on my page as well to my feed, the event itself, and you can click in there and you can comment with any questions or raise your hand. So the first question is, what is the current state of crypto tax policy in the US? And I thought this was a good question because obviously this is a huge topic that everyone's probably seeing in the headlines this year. We've seen a lot of tax changes, but they all follow a common theme that I have basically been tracking with the IRS, I would say, since about 2016. So really where the IRS started with their tax enforcement was with information collection. And back years ago, it really was taking the form mainly of John Doe audits. We're still seeing those until today. Most recently, we saw that with Kraken, where Kraken is going to have to provide records for taxpayers from 2016 through 2020, I believe. So the IRS has been gathering information on taxpayers for years and years through John Doe audits, through information reporting that they've required over the years. And they have been sending out notices to some taxpayers who they believe have not been reporting all of their transactions. And the IRS even recently published that based off of all of the data that they've collected, they believe that non-compliance is at what they estimate to be 75%. So basically, they believe 3/4 of people are not reporting taxes, and this is based off of information they have. So I would say, historically speaking, the IRS enforcement has mostly been on information collection and then, sending out some notices to taxpayers who aren't reporting. Now we're seeing more guidance given by the IRS in this current year in the form of some proposed regulations on how NFTs are going to be taxed and how what they define as brokers are going to have to report information for people's transactions. So they're taking this sort of reactive information collection that they've been doing for years, and now they're trying to be proactive and force information reporting from who they define as brokers. And the problem with this is, and where a lot of people are having issues, is how they're defining brokers and who exactly they're going to be collecting that information from. So with the current state of crypto tax is that there is a lot of changes taking place. There's going to be an increased level of complexity, but also that comes with that maybe some regulatory clarity. But the level of information that the IRS is going to be collecting from a lot of different participants within the space under these proposed regs are somewhat concerning and are going to create a very large compliance burden on many taxpayers. So that was the first question. Let's see here. So the next question is, what is the current crypto tax legislation that's being proposed? So these are the broker regulations, and these are still proposed regulations. Right now, there's a lot of contention around these within people within Congress versus a lot of people within the crypto community. So there's a lot of pushback from the crypto community on the reporting standards. And the basic reason why is because of what they're defining as a broker in the proposed regs. And basically, most decentralized exchanges are gonna fall into this category of a broker, which is going to lead to most decentralized exchanges and protocols having to report information and collect information from taxpayers. And this would include their address, their social security number, obviously all of the information related to their transactions. These proposed regs, based off of what the IRS is saying, is gonna more than double the total amount of 1099s that get filed with the IRS, not for within our industry, for the whole entire United States. So it really is an unprecedented amount of information gathering that we would see here if they make places like Uniswap and OpenSea and places like that start reporting on taxpayers. Basically, the reason why they're saying these decentralized exchanges have to report is because that they're claiming they're not fully decentralized, and decentralization always happens on somewhat of a spectrum. And within the definition in the proposed broker rules, if they define, if someone is effectuating a transfer on behalf of another person, which is basically, if you can log into a front end website and click swap, they're going to put people under that definition. Then they're saying that they have to report. So that's why a lot of these decentralized exchanges, because maybe their front end websites are not fully decentralized, or maybe they have some capacity to control the fees that are being charged to their users, they're not going to be viewed as fully decentralized in terms of these proposed regulations. And as a result, they're going to be forced to report. So again, there's a big pushback in the crypto community right now. People are actually using AI to send comments in during this comment period to the IRS, speaking against the proposed regs. And we've already gotten an extension on the comment period as a result of that. So we'll see where that goes. Right now, like I said, there's also people like Elizabeth Warren and others in Congress basically pushing for this to be implemented, and even be implemented faster than it currently is. So we're going to have to see where that goes. But overall, there's going to be a higher level of reporting standards that are going to get applied to digital assets. And there's going to be a lot of changes to the tax reporting and accounting requirements for companies over the next 1 to 3 years, I would say. Another question is, how are states changing their NFT tax laws? So a lot of people are focused on the proposed regs right now, and I would be included in those people. But there are a lot of other tax considerations to digital assets, and one that is, going widely overlooked right now is sales taxes, and how that is going to apply to on-chain transactions. Because in many cases, taxes may be applicable. Specifically, for people that are selling NFTs, we've seen several states indicate that NFTs are taxable for sales tax purposes. And in many of these states where they've indicated that it's under the definition of digital products and goods, which is something that in most states has been taxed for years. Therefore, a lot of these taxes on NFT sales can potentially be retroactive on these companies. So right now, if you or a client of yours are selling NFTs or selling other goods and products on chain, you need to start really taking into consideration, do sales taxes apply to these transactions, and how can you get into compliance with that? And if you have been selling NFTs in the past, in states like Washington and other states, you need to also consider what type of retroactive tax exposure do you have there, because because there is a risk, and going forward, I'm projecting that there's going to be over 30 states that are going to apply sales taxes to NFTs, or which really NFT sales taxes already applied. There just hasn't been guidance given yet. And that's based off of states that are, like I said, already taxing digital products and goods. So this is another area that we have to watch closely, and that I'm working with many clients into getting them into compliance with, and trying to be proactive to avoid future state tax issues. So let me see here. So next question. What does the update to FASB crypto accounting mean? So, like I said, there's been a lot of regulatory updates this year. So the FASB updates, these are for accounting purposes, for GAAP accounting purposes. So these aren't for tax purposes or IRS related, but companies that are reporting under GAAP accounting standards. Think, for instance, like Michael Saylor's company or Elon Musk's company that's holding crypto assets on their balance sheet. They're usually going to have to follow GAAP reporting standards along with many other companies. And historically, under GAAP, they were reporting cryptocurrencies as intangibles and valuing them at historical cost less impairment on their balance sheet, which basically means that each year they would show the losses on their financial statements to their investors, but they weren't able to show their gains if they didn't sell those assets to their investors. What the crypto accounting updates mean is that now they're going to be able to present their crypto assets on their balance sheet at fair market value, which is going to be overall a more accurate, or just a truer representation of these assets that these companies are holding. And I believe many others believe that this is positive, not just from an accounting perspective, but for the industry as a whole, because it removes somewhat of a disincentive from companies holding Bitcoin and other assets on their balance sheet, because now they're going to be able to not have to just show their decreases in the value to investors. They're going to be able to show the appreciation as well. As when we're considering something as volatile as Bitcoin and other crypto assets, you can see how that's going to work to companies' advantage just from a financial reporting and investor reporting standpoint. So overall, I was pleased with the updates from FASB, and I actually was quoted in an article in Accounting Today, I think a month or two back on that. That's listed on my LinkedIn page, where I go into some more details on that as well. So if you're interested in that, definitely check that out. So the next question is, what are some year-end considerations for investors related to tax and accounting? So there's several things that you want to consider as a cryptocurrency investor throughout the year, but particularly at year end, because this is really your last chance to take any actions within this tax year. Right now, we basically got 2 months left. Before you can really get into any tax planning, the first step is going to be getting your accounting up to date. And that sounds very simple, but that's usually the first bottleneck that I'm going to hit with a new client that's coming to us at year end. They may want to know about different tax strategies, look at loss harvesting opportunities, but we need to get your accounting up to date and accurate. And then what my next step would be looking at what your portfolio looks like. What type of gains do you have in your portfolio? What's the level of any income that you have, any expenses that you have, and what assets are you holding? What is your cost basis in them? What is your holding period in those assets? And what is the current market value of those assets? Then really the next step is going to be looking for loss harvesting opportunities on an asset by asset basis, considering how wash sales may or may not apply, and looking for opportunities to Are there book losses against any gains that you may have, or book losses for future gains that you may have? So really getting your accounting up to date, looking for year-end loss harvesting strategies are usually going to be steps number 1 and 2 for almost any portfolio I look at. Then, it's going to get somewhat, specific to each person in terms of what moving pieces they have from a tax perspective and what other tax considerations we'll have for them. But really, if I'm talking to an investor, I want to see you get your portfolio up to date, looking for tax loss harvesting opportunities now, and then also doing a tax projection to see if you owe any estimated taxes, because that is another thing that goes overlooked so much, is paying your estimated taxes on a quarterly basis and before January 15th. So that would be my piece of advice to investors right now that are looking for year-end strategies is get your accounting up to date, look at your year-end positions, do tax projections. You want to avoid having any surprises during tax season. In that exercise, you're really going to be considering all aspects of your taxes, and then you're going to see, is there any other opportunities that we need to look at and consider where we can minimize taxes, or is there anything that is unexpected that we still have to address before tax season? Let's see here. So the next question is, what is the biggest mistakes that I see investors or businesses make? All right, this is a good one. I think this is a good one to be talking about right now. So there, obviously there's more than one, but as we, come up against the halving and possibly move into 24 and see another bull market, people's mindsets are going to shift. And one thing I see when people start, getting all these positive feelings from these bull runs is that they think the prices are never going to come back down. And then one thing that inevitably happens each cycle is it can take several forms depending on each specific person. If it's an investor, they may be taking profits from altcoins into Ethereum, or taking profits into Bitcoin if they're going that route. That or if you're a Web3 company, you may be getting paid in Ethereum, paid in another crypto asset. Every bull cycle, I'll have people that come to me and they basically had no treasury management. They hold their tax liabilities in the crypto asset. So picture someone that's getting paid in Ethereum and they don't have other funds that they've set aside for taxes. So they got paid in Ethereum and they're going to pay their taxes out of that payment that they got in Ethereum. That person then holds that Ethereum through the year, and you're taxed on the fair market value of it. Then a tax season will come along and another bear market will come along and Ethereum will drop by, say, 50%. If you're paying your taxes out of that Ethereum, you basically doubled the taxes that you're going to have to pay. And you're going to have this painful experience of basically having to sell the bottom just to pay for your taxes. And it's just a terrible scenario that I like I said, I've seen every cycle so far. So number one is, when the bull market comes, or just in general, I don't recommend this at any time, is do not hold your future tax liabilities in crypto. So like I said, I've seen that every cycle. I also help people avoid it every cycle if they're working with me and I'm able to plant that seed in their head. But it's something that you definitely want to keep in mind. Another huge issue that I see is inaccurate cost basis tracking. That usually results from some type of lack of due diligence overall on the accounting portfolio. In this, I see this surprisingly across people that are, managing their accounting themselves, or, even with people that are working with accounting firms and CPA firms. And it's something that you want to scrutinize very closely, regardless of who you're working with, whether it's a CPA or a software. You never basically want to, blindly trust any of these service providers. And there's many due diligence checks that you want to do, but One that I'll hit on briefly that goes overlooked is comparing the calculated detailed ending closing positions, your ending cost basis, to what you're actually holding in your wallets and exchanges. It sounds very simple, but it goes widely overlooked. And it's not uncommon that people will come to my firm as a potential client at Camuso CPA, and sometimes they don't even have the information. They don't even have the ending cost basis details. Or sometimes they'll only have a summary of it. They won't have the detailed tax law version of it, which we need. So that's one issue in and of itself. But then other times they will have it, but they'll just be glaring inaccuracies on it. And that really should have been an indication when that accounting was getting complete that something was off, that needed to be investigated further, and that needed to be reconciled appropriately before the accounting was complete and before the taxes were filed. Why this is such a huge issue, because if I see something like that in your ending basis, before we can start working with you on the current year, we need to go back and address that issue. And that is because there's a cumulative nature to your tracking your cost basis. After the first year, if you're still holding an asset through 12/31, that's going to carry into the next year. So miscalculations from previous years can carry into future years. So it's just very important for to be sure that you're accurately filing your taxes for the current year, but then also to be sure that you're going to even have accurate accounting in future years. You need to be scrutinizing that ending cost basis details. And then, man, what's the next biggest issue? Because there's quite a few that I've seen over the years here. Another big one is just commingling funds. I see this on the Web3 side with companies, and I also see it on the investor side in their portfolios, where people will either the two most common ways is people will usually during a bull run tell their friends and family about crypto, and then somehow end up taking funds from their family and trading it on their behalf. Maybe their family wants to buy, whatever crypto asset. They don't have an exchange account, and they're like, oh, okay, I went and I purchased this for them. That creates a tax and accounting nightmare for you. Firstly, you're going to have to either yourself or with your CPA or both of you together start parsing out all of these transactions. Then you need to consider, for tax reporting purposes, who are these exchanges registered under, and what type of 1099 reporting are they going to be issuing on your behalf or on the other person's behalf. Depending on the amounts, we need to get into, possibly gift tax returns if some of this is going to be treated as a gift. So it just creates a real mess if you start commingling funds and investing on other people's behalf. So fight the urge to do that, or if you hear someone doing that, I would definitely sort of recommend against it, because it's going to really hurt you from a tax and accounting perspective. And then similarly, especially for like a newer Web3 company that's just getting started, usually in the beginning there's going to be some type of commingling, at least with non-custodial wallets, where it was a personal wallet, but then you start using it for business transactions. Again, we're going to have the same issues. We're going to have to really, put a lot of extra effort in on the tax and accounting side, and it still probably isn't going to be perfect once it's all said and done due to that commingling. So it's going to create just an added layer of complexity and a lot of tax and reporting issues. So that's another thing that that I would say to avoid. So that was a great question. Let's see here. So what are the biggest misconceptions about crypto taxation? Well, I would say there's a few. I think the biggest misconception would be, like the IRS just recently released information based off of their records. Like I said, 75% non-compliance. And I've been doing crypto accounting full time since 2016. So back then it was a lot worse than now, but there's always been a lot of people, a lot of, anon profiles on Twitter that just, just basically believe you can do tax evasion in crypto. And I believe that they're wrong, and they're going to really, learn the hard way. It's just going to basically take some time because most blockchains are public immutable ledgers. And a lot of people believe that the blockchain is anonymous when really it's pseudonymous, meaning that all the IRS has to do is connect an identity to any of your non-custodial wallets, and then they're going to be able to tie you to those transactions for tax purposes. And that's really what a lot of the John Doe audits and the information gathering over the years, and even now as we see with these proposed broker reds, a lot of that is basically for these purposes of building out a fact pattern on you and seeing what transactions are actually attributed to you. So I think that's a huge misconception. Another misconception that kind of ties into a lot of these cost basis issues is that a lot of people believe that you can basically go onto any one of these crypto accounting softwares, plug in your wallets, pick whatever accounting methods they offer you, and it's all just going to be accurate and work out from a tax and accounting perspective. And although these are valuable tools that we use as a CPA firm, it's just not the case that any of this is going to be plug and play like that. There's usually going to have to be a lot of work done from a reconciliation perspective, adjustments made from a tax perspective depending on the tax treatment of specific transactions, and a lot of due diligence done for the overall accuracy of the portfolio. So I would say that those are the two biggest misconceptions. So I really wanted to keep this short and sweet today. I had it scheduled for 30 minutes. I have a ton of questions here. We only covered a few. I really appreciate everyone pushing out all these questions. I have a list of about 30 questions here. I think we only covered maybe 9 or 10 of them. So I really think I'm going to schedule some additional events here, especially as we move into tax season. I know taxes start to become top of mind for a lot of people, and I really want this to be an opportunity for everyone to ask questions and get them answered. Jared, I'm just seeing your question now. I have a jurisdiction question. I'm working on a DAO project for United Nations. Would a UN DAO project be under the jurisdiction of a U.S. tax authorities or any other tax authorities? So with the DAO, I would really want to get a deeper understanding of its legal structure and what type of company or an overall entity structure that you have set up for it. And really that would be my starting point to start determining what type of tax jurisdictions are going to apply to it and what tax implications are going to be associated with that. So that's a great question. But that's something that, we'd have to parse through a lot of details to really get you a good answer on. I'm happy to discuss it further, or if you also wanted to post some more details, we can certainly parse that out more. But I think it's a great question, and you should definitely be proactive in your tax considerations around that. So I really appreciate you asking that question, and I wish I could give you a better answer, but that's probably the best I can give without more details, at least for right now. So like I said, there's a ton more questions here, so I'm definitely going to schedule another one of these soon, and look out for that post on LinkedIn. In the meantime, feel free to join my newsletter at camosocpa.com. It's called the Digital Asset Digest. We also have the newsletter posted to LinkedIn as well, so you can just go to my profile and sign up for it there. I'm putting out information there every week on updates on a lot of the tax topics that we discussed and much more. So definitely check that out, and keep an eye out on my profile for the next event like this. And I really appreciate everybody joining here today. Until next time, I'm Patrick Camuso signing off.